Welcome to Talking Technicals here on Money Life, where we will demonstrate the technical analysis is not just mumbo jumbo. We do that by bringing in some of the best experts in the field. And today, one of our favorites is back with us. Michelle Schneider is chief strategist at marketgauge.com. If you go check it out, they have plenty of stuff there that's going to help you be more aware of the market's technicals. Miss Schneider, it's great to have you back on Money Life.
It's so wonderful to be here, Chuck, especially on this very interesting week after it seems like we have the major event of the week happening for the last 3 weeks.
Well, we do. And so let's start there, because that is the elephant in the room. It's not where I normally start our conversations, because politics is not a technical thing until something happens and it moves to the market. And the market was maybe starting to show signs that it was pricing in a Trump victory. Now we have President Biden saying he's stepping out of the race, endorsing Kamala Harris. So I don't know that that's a technical event, but when does that show up in the technicals, or what does it do for the technicals where you now have a more contested election potentially hanging over the market for the next couple of months?
Well, I think my observation of the market really over the last several years has been that we may or may not get a knee-jerk reaction as a result of some political event. I mean, and I'm not talking geopolitical. That could have a much bigger response. But nonetheless, what we do see, though, is the market seems to be somewhat departed from all of that, because I think it's far more focused, really, when you come down to it, to what the next monetary policy is going to be at this point. And there's been a lot of anticipation, wrongly, clearly over the last couple of years, that the Fed was going to start cutting dramatically. And now here we are back to that sentiment that it could be in July, could be in September, but that the market is now anticipating that with inflation numbers cooler, some of the economic statistics a little bit contraction, labor market maybe cooling off a little bit here, that it would be time for the Fed to cut. And even though Europe didn't, Canada has, and now obviously China did over the weekend. And so we can see from a global standpoint, there is more leaning towards an easing. And if that happens, the market, well, I should say segments of the market will like it. Other segments won't. So we have that, and we have earnings season. And I think that's really going to be ultimately always go back to exactly what you say, Chuck, is always go back to the price, because the price is really going to tell you what's going on more than any kind of speak of a politician, particularly while they're in campaign mode.
Well, but earnings season, most of the forecasts for this earnings season have been really strong. Like, people are expecting absolute banger earnings this quarter, which, by the way, also sets up for the next quarter maybe not being as good, and that would be when we get a rate cut. So again, earnings, not a technical event until it shows up in the charts, but how much is that playing out now in anticipation of that?
Well, so far, we started with bank earnings. So if you look at the financial sector, you can see that it's done very well. And one of my economic modern families, which is regional banks, finally broke out of a trading range between 45 and 50, had been trading in for quite some time. Hasn't quite gotten through its next level of resistance, but I like to look at the regional banks because it gives you a better idea of the inside of the U.S. economy as opposed to the big banks. And obviously, J.P. Morgan was the biggest winner of all, with a lot of money that has gone into investing in that arm of the banks. Then we moved to Netflix, which reported last week. And even though it reported well, and initially sold off, and now, as we're watching the market, it's starting to come back. And then we have Tesla and Google this week. So I think that Tesla's going to be very interesting. That's actually become a little bit of a political football. But Google is going to be looking at that, obviously, with AI. And I think that the earnings could be very mixed. But I think overall, the negativity in the market that we've seen even before the election happened, and whether it's going to be Harris or Trump, right now we still have the consumer kind of, I think, really the thing that has to be watched the most. And that we can watch the consumer through XRT, which is the retail ETF that comprises both staples and discretionary spending. And that has definitely been underperforming right here.
And as you talk about watching that, I mean, is there something specific you are looking for in terms of how that trends, et cetera, to tell you that now is the time that the consumer is weakening? Because we're seeing some things that are alarming, but it hasn't actually stopped the consumer from holding up their end.
Absolutely. And so I would think right now we should be looking at, if you just wanted to really make your life simple, I like to look at XRT. It's been the grandma of my economic minor family for a long, long time. And if you're taking a look at the chart right now, you can see that, first of all, we have a July reset of a calendar range. We do 6-month calendar range resets in January and July. Now, July, especially starting last week, seasonally should be relatively weak as we're going into August, and then things start to pick up as we get into September. And that's exactly what you're seeing in XRT. It's entering, trying to rally, but it could not do it, but yet it hasn't really fallen apart. So I'm looking really basically there. And if we cannot get back up above, say, 78 to 80 in the retail sector, that could actually not only spiral the rest of the market lower. I mean, obviously, semiconductors and tech is going to do what semiconductors and tech do. But that, I think, would put pressure on some of the other areas of the market and then possibly force the Fed to come out and lower those rates, which is why we're also watching the long bonds here, the TLTs. So that's the first thing. I mean, in terms of the classic retail areas, we're going to start looking at Costco earnings are going to start coming out. I mean, you start looking at those charts, you can see where the consumers are going, more into the staples. Obviously, Walmart being another one that has been relatively strong, sitting here near the highs. But of course, if you look at more of the discretionary areas, that's really where you're starting to see some of the bigger problems pop up. And so it's a very bifurcated market. And looking at all of the major sectors right now, what is so interesting is, they've all popped up, but they also are all very undecided right now about what the next direction should be. And that makes a lot of sense when you think about it, right?
It does, especially because we're at the edge of the map. With the market at record highs, we're in uncharted territory. And as I always point out, back in the olden days, before we were able to map the earth, you'd get to the edge of the world and you'd label what you didn't know as, here there be monsters. So given the bifurcated market that you see, if I had to push you a little bit on what you think the market is going to do next, are we staying on dry land or are we encountering the monsters?
I actually think we're staying on dry land. I really do. I think that regardless who becomes president, they both have the agenda of essentially infrastructure and reshoring, bringing things back into the United States. They may go about things differently, obviously, where, Trump is talking more about lowering taxes and raising wages, and the Democrats might be talking more about maybe raising some taxes. The point is that both are looking to shore up the economy in the United States and maybe do a little bit more anti-globalism, and that I think is making people feel confident, because if there's any country in the world that can do that can be more independent, it is the U.S. Obviously, we're rich in natural resources, whether you want to drill more or whether you want to put more money innovatively into solar. I mean, we got it all here. We've got good borders, oceans, Mexico and Canada. So I don't know if necessarily the approaches make the difference more than the optimism about the country right now. So the only things I think that could wreck that would be obviously some kind of full-scale war, because now, of course, we're talking about shortages of raw materials, and we've certainly seen commodities come down, or, potentially some kind of major social unrest in this country. But I don't think you hear about the anger, but really most people, I think, just want to be kind of left alone and go about their business, or some kind of event to the dollar. That would be another. And of course, you're always hearing these stories about BRICS, and all these countries wanting to do gas and oil and petro out of petrodollars, and gold, paying for things in gold by China, et cetera, et cetera. But the point is that the dollar hasn't really done very much except go into a trading range. So any of those things could break, but they haven't. So right now I have to be continuing sort of bullish.
And is there a level of resistance? Is there a move up that you are expecting? And is there a move down that would make you say this is more than just a buying opportunity, time to get a little more cautious?
I would say, well, if we're going to look at the SPY as the benchmark, which is a really good one, 5,400 would probably be my kind of line in the sand as support. And if that broke down, then it's possible that maybe we would have to take another trip down to like, I don't know, 4,800 to 5,000, hard to say exactly where. But as long as we're holding this 5,400 level, clearly we had some resistance at 5,600, which was a target for a lot of actual technical people. Said 5,600, we got a little bit above that, not very much. Then I don't see any reason why we can't continue on up and check out 6,000 as many people think. But for right now, I like the fact that we can look at this sort of now range between, let's say, 5,400 and 5,600 and see kind of what happens there before we all get too crazy. And it's the summer. So you do have a bit of a summer doldrum. And like I said, seasonally right now, we're not going into the strongest season. In an election year, generally that supersedes. But I just read that also, seasonality, when the incumbent is no longer running, sometimes that means that the election season could be a little bit dicier. So, yeah, I mean, I know that may not be exact, like, yeah, do this, do that, do this. But I think that people who are being definite are being a little bit remiss in all of the potentials out there. But like I said, more for me, I'm more optimistic than I am pessimistic right now.
Well, we love that because functionally we're optimists here on Money Life. Mish, this has been great. Thanks as always for coming on the show. We'll talk to you again down the line.
Thank you so much, Chuck. You have a great day and week.
That's Mish Schneider. She's chief strategist at marketgauge.com.